Welcome back to Surviving Retirement. My name is Peter Guidotti, Chartered Accountant, Certified Financial Planner, and Senior Wealth Manager. As we reflect on 2024, one of the defining stories of the year has undoubtedly been the U.S. elections. With the results now finalized, Donald Trump is set to be sworn in once again as President of the United States on January 20th, 2025. In a previous video, we highlighted how over the long term, the S&P 500 has demonstrated resilience and consistent growth regardless of whether the Republicans or Democrats held power. To help us explore how a Donald Trump presidency could shape the market dynamics, what his agenda might mean for investors, and the potential ripple effects on Canada, we're thrilled to welcome Martin Roberge, Managing Director and North American Portfolio Strategist at CG Wealth Management. Martin, welcome to Surviving Retirement.
Thanks for having me.
A few days ago, you published your outlook for 2025, and in there you addressed the aggressive tariffs that Donald Trump has been proposing, and in particular the potential for stagflation in 2025. Can you walk us through what stagflation is and what you see the response might be of the central banks?
Yeah, stagflation is a level of very slow economic activity, but with inflation creeping through the economy, sometimes not allowing central banks to do their magic and ease interest rates when the economy is slow or slowing down. So that's obviously a key risk going into 2025.
There's some talk about global supply chains as well in your report, and with Trump back in office, there's a chance that we can see a lot of trade tensions heating up again. So do you think that's going to affect global supply chains, and if so, is there going to be a realignment, and which industries do you think could be hit the hardest?
Before we talk about the repercussions globally, I think we need to understand how harsh could Trump be on the tariffs. So we did some math, and we calculated that if Trump goes with a 10% blanket tariff, it's going to create probably an inflation jump of 0.5%. If he goes with 25, that's another ballgame. That's a 1% increase in inflation next year. So because he's been elected to contain inflation, we really doubt that he's going to go with 25, especially when it comes to Canada. Most of the goods that we export are strategic in nature. Primary goods are semi-finished goods that are well integrated in the U.S. supply chains. So when it comes to the impact, obviously it's more of an issue for the Euro area and China, because their goods are more finished goods like BMWs, Mercedes, and China, as you know, it's IT equipment. So those are obviously more at risk. But that being said, Trump was elected in 2016. So with these, it's not the first rodeo for these countries. So they have been moving away from the U.S. They have been diversifying their export markets. So for example, China, it's now only 15% of their exports going to the U.S. It used to be 25%. So China does a lot of its trading with other emerging markets or emerging market economies. The world economy and the main trading partners have adapted, and they know that if we have a situation where trade tensions escalate, it will create eventually some pricing pressure on goods. But since they have been diversified away from the U.S., the impact on inflation or on goods prices likely to be less than in 2016, 2017, for example.
Does that include Canada as well?
Yeah. Canada, for as we just said, like the fact that we are sending like primary goods and primary commodities, and understanding that Mr. Trump wants to really probably get harsher on Mexico. Well, you cannot cut off your suppliers like all around you. So actually, if he's harsher on Mexico, Canada may be winning market share from Mexico.
Might benefit from all
exactly.
this. Very interesting. In particular, you were talking also in the report about the impact on U.S. small caps in particular, potentially domestic growth. So in terms of areas in tactical positioning, Do you see the U.S. small caps, mid cap space as an area that perhaps investors should be looking at?
Yeah, what's unique in 2025, actually 2024, 2025, is that we have an election cycle, also a monetary easing cycle. The Federal Reserve really cutting interest rates to stimulate growth. So it's really unusual that you have both factors happening at the same time. And we know that Trump's trade policies and fiscal policies, like the tax cut, will benefit, relatively speaking, more the smaller caps relative to the large caps. That's number one. Number two, as you know, large cap growth stocks have been the leaders throughout this bull market.
Mag 7.
And Mag 7, for example, have been the key winners. And they are now reaching a level of valuation where probably it makes sense to de-risk, or let's say reshuffle portfolios so you don't deal with too much concentration risk. So to reduce that risk, if you don't want to rotate outside the market, you can do it inside in areas that have been shunned by investors. And small caps have rarely been so cheap relative to large caps. They will benefit from tax cuts, obviously, and if there's a trade war, like we saw in 2018, 2019, it is the larger caps, which are more globally geared, that will face probably tariffs or retaliation moves from Germany or from China. These countries can also retaliate like they did in 2018-19, but small caps are more, again, domestic centric and less sensitive to retaliation forces.
And a lot of research we've been reading have talked about the relative valuations that they didn't participate in a lot of the run-up that we've seen.
And that's
recently.
a big difference from Trump 1.0 back in 2016. And this is the pushback I get when I talk about small caps, is because back then the rotation in smaller cap equities was very short-lived. And the reason was because going into Trump's election in 2016, they were very, very pricey, trading at a 20% premium to large caps. This time around, it's the opposite. They are trading at a 20% discount to large caps because of the Mag 7 outperformance.
Right. Very interesting. Okay. We're talking also about commodities for a second. In your report, you were talking about perhaps a bullish phase for commodities in the second half of 2025. So how do you think that the Trump's policies could affect possible tariffs on Chinese imports? Could the timing or strength of that recovery, especially for industrial sectors, metals, copper, that area?
When we go through rising trade tensions, it creates a pocket of uncertainty that slows the economy down. Okay? And obviously, the slower the economy, the less the consumption of commodities. But we have to remember, commodity demand is coming mostly from emerging markets, such as China and India. Those are the countries importing a lot of commodities to manufacture goods and resell them in global export markets. So I don't think there's much of an impact when it comes to Trump. It's more like other factors, such as, will we see finally a bazooka stimulus from the Bank of China or from the government? How long does it take for this year's rate cuts to filter the economy and then get manufacturing activity going again? Because commodities, it's all goods consumption and really sensitive to manufacturing activity. We believe that the rate cuts will start to filter the economy in the second half of the year, next year, and probably the market will look out at 2026 being the year where finally people stop maybe experiencing things and buying stuff again. So second half of 2025, probably a good entry point for commodities.
We see some things settling down as well as the dust settles as well.
Yeah, and the good thing also is that from a reward to risk ratio, the downside risk on commodities is quite, I don't want to say limited, but protected from the fact that we still have this long-term green energy transition that will require a lot of commodities.
Interesting. Very good. Lastly, I just want to turn to the Canadian dollar. It's been in the news lately. And for the Canadian snowbirds that are heading down to the U.S., not such a great time. It dipped below the 70-cent level just recently. So even with the most recent drop, though, in your report, you're calling for stability going forward thanks to strong foreign inflows. Could you tell us a little bit about that?
Foreign flows are what foreign investors are buying in Canada. They're buying essentially stocks and bonds. We know that they are buying a lot of Canadian bonds because the economy has been weak in Canada and the Bank of Canada is cutting interest rates. So our bond market is very attractive for foreign investors. Also, starting in September, when we had the first Fed cut by the Federal Reserve, people said probably we need to allocate a little bit of cash outside the U.S. because the U.S. has done very well. And Canada was one of those countries that benefited from foreigners' investments. Okay? So we've got foreign buying supporting the dollar, but at the same time, there's an opposite force, which is the dollar that needs to depreciate to account for the potential tariffs. But if the tariffs, okay, are limited to that 10% blanket, we calculated that the depreciation of 8% this year has done much of the adjustment.
Already.
Okay? That's number one. Number two, let me give you just a couple of stats, like two stats. 3 months in 2016, 3 months after the Trump election, where was the Canadian dollar relative to the day that Trump won? You remember?
I don't remember, no.
Was that up 5%?
It was
so
up.
from November to February 2017, it was up 5%. Now, November 16 to November 17.
What happened then?
Up 10%.
Another rise.
So we have to be careful about buying like the ongoing bearish sentiment, because one thing is for sure also going to next year, there will be a change in leadership in Ottawa.
Yes.
Okay, and obviously when a new government comes in, usually you kind of start from scratch, and like 70 cents is probably overdone. We cannot rule out like a final flush upon Trump's like being maybe harsher than we believe in when he takes the House on January the 20th. But throughout the year, as we saw following the several U.S. presidential cycle, going into the election, the Canadian dollar always goes down because U.S. government, or they want to go after everybody.
Right.
Okay? And then 1 year out, usually the Canadian dollar re-rates or appreciates slowly, but they do appreciate. So I would be recommending probably for folks looking at their strong U.S. dollar gains to start slowly but surely convert some of those gains into Canadian dollar.
And do you think that some of this weakness in the Canadian dollar, I guess safe to say that it would offset some of the potential impact that some of the tariffs?
Yeah, actually the 8% depreciation, if he does 10, usually the rule of thumb is half, is 50%.
Okay.
So if he does 10, the rule of thumb is that the Canadian dollar must depreciate by 5% to make the adjustment.
Interesting.
Okay? If he does 25, obviously it's 13%.
Yeah.
So we may go
a little bit more.
A little bit more. But this is what I would say probably I hate to use this word, but probably the final puke, okay, when it comes to the Canadian dollar.
Well, one thing for sure, we're going to have more volatility as time goes on, and we'll see how the dust settles.
All right.
Terrific. Well, that's all the time we have, Martin. We appreciate your insights. Thank you so much for joining us today, and we look forward to having you again with us in the future.
Anytime. Thanks.
Excellent.
Bye-bye.
And so to our audience, thank you for being with us. We hope you found this discussion informative and insightful. If you'd like a complimentary copy of Martin's 2025 Outlook, let us know by clicking the link in the description below. Until next time, be kind to yourself and to others, and we'll see you in our next video.